We're moving from a low hire, low fire kind of job environment to firmer jobs growth. There's a cyclical upturn. It's firming. Absolutely. The reason it feels strange is because there's been a lot of strange things happening. Look, we almost had a recession in 2022. Output, sales, income were all heading down. But jobs held in there, so we didn't have a recession. And this is because of some structural stuff post-COVID and so on and so forth. So as a result, in this recovery, we're having kind of what feels like an echo of a jobless recovery. It is definitely directionally firming. It's super tight on it. You see in the short-term unemployment. That's what you see. Mm-hmm. That's why the jobs numbers aren't falling. But in the longer-term unemployment, that's actually rising. And that's, I think, related, our research shows it's related to jobs mismatches. I mean, mismatch of skills. If you're not leaning into the AI kind of productivity enhancing stuff, if you're unable to do that easily, you're going to stay on the shelf longer.
That's what Jay Timmons said yesterday. I'm sorry, I went right to Alexis on the show top.
Yep.
Excuse me. I'm sorry. I was focused on Duke, Michigan this weekend. Excuse me.
So what's it feel like here in terms of a lot of folks are saying, boy, the folks coming out of college, some of those emerging entry-level jobs, they're just not there. Is that is that true? And B, is that an AI-related issue?
Yeah, look, if you were coming out and going to do simple coding, you're in trouble. Okay. If you were going to do simple research, not going to really happen, right? If you can turbocharge AI for your productivity and explain to the older people how it works, you're going to get hired. And that's the shift, the pivot that you're seeing. And you see the economy first. Let's back up for a second. There's actually 3 cycles. There's cycles in growth, cycles in employment, and cycles in inflation. The economic cycle is firming, as we discussed earlier, and that is making employers have to hire, and they're hiring. So if you've got skills that match up, you're getting hired, and you won't stay unemployed very long if you should lose your job for some reason.
How about the wage environment out there? I mean, we're still seeing 3.7, 3.8. That feels pretty darn good.
Yeah.
I'm not sure if it is, though. How is that?
Well, it all depends. You know, this is the economics, right? It all depends how fast prices are rising. Yeah, sure, it's great to get a raise, but if it costs you more to live, you're treading water. And so I think that is the struggle that is going on here. And if I may, if we're right and jobs are firming, which is basically the headline, right? Even though there's some unevenness underneath, then that sets you up sooner or later for some knock-on or more persistent inflation pressures.
Yep.
So as Goldilocks as things have been, it requires not too hot, not too cold. And that may get wobbly here. That's what we're looking for.
I'm of the opinion that AI is a net job destroyer. Am I wrong on that? I just can't see a scenario where it doesn't. Yeah. I think about all the stuff I did the first 3, 4, 5 years of my entire career, maybe even now, can be done by AI. I don't know.
Yeah, I think so, but it takes time. That's Solo's old quote. I see productivity everywhere except in the statistics. And so look, it takes time. Is it gonna happen faster than decades, which was his point many decades ago? Yeah. Probably. Yeah, it'll happen faster than decades, but that doesn't mean next quarter.
Yeah. Lakshman Achuthan with us. We continue with them with the Economic Cycle Research Institute. Get their research directly from ECRI. I can't say enough about how different it is than what's out on the street. What is the distinction now in your research note that is different from consensus market economics?
Look, I just alluded to it. You're gonna, and I mentioned this last time. You got to watch out for inflation cycle upturn later this year.
Okay, Adam Posen and Peter Orszag, they love your work. They love the history of Jeffrey Moore. But the bottom line is they're modeling out sustained or even higher inflation off of wage dynamics, less immigration, less labor force, wage persistency, and higher. Is Adam Posen correct?
Eventually. What happens is the wages are actually not a leading indicator of the inflation cycle. So I'm afraid if you wait and you have to see that in the rearview mirror, you might have missed the boat, which is why we look at the future inflation gauge. And the future inflation gauge has been getting a little traction, I have to say, and I've been foreshadowing that for you guys the last couple of months. I'm still foreshadowing that. I think that's the next story. But underneath that, or even before that, the whole reason for the Fed to be mellow is that the jobs market is not good. And I've just described for you, hey, longer term unemployment, yeah, there's an issue. That's your headlines. That's the skills mismatch. Shorter term unemployment, not at all. That's very low. Employers are hiring people, and I think net, that's going to firm to the upside, which removes the near-term cover for the Fed to be easy, even though they may want to be. And then the knock-on, Tom, is if you have inflation like Posen and others are modeling in their models, we're using non-model things. But if that's coming down the line, that's different than Goldilocks later this year. And you've got a global industrial upturn underneath the whole thing.
The Fed, I'm still looking at the WIRP function on the Bloomberg terminal, still looking for a couple of rate cuts this year.
Is that what we are thinking?
I think, but that's interesting. That makes it interesting.
Yeah,
that makes it really interesting because you've got the terminal and everybody saying, hey,
is
let's
that where
look
we
this
are?
way.
2 rate cuts still?
Yeah.
I've lost track.
Exactly.
I'm worried about U.S. Canada hockey.
I know.
So let's bookmark this conversation and come back to it.
Okay, Nora Rubini's in yesterday.
Yeah.
Acclaimed international economics. People I hate, and it's part of his charm. He knows I hate the phrase Dr. Doom. He was the most optimistic yesterday I've ever seen. He called it I'm calling it, folks. Sarah, help me here. Out on YouTube, the banner says the Rubini 4% economy.
Yeah.
He says, forget about 2% growth.
Yeah.
Out there in a longer term, 3, even 4% growth.
Well,
really? 60s?
Longer term, I don't know. He might know more than I do on longer term. I'm not sure there. Cyclically, sure. And by the way, we said this in the second quarter of 2025 when everybody was running for the hills. So directionally, it's all about timing, right? You can make a forecast that, hey, AI is going to eat us for lunch and we're not going to have a job. It could take a while.
Yeah.
And what do the markets do in between here and there? And that's what the cyclical stuff is. It's very powerful in my experience when a longer term view, like stronger growth, for example, lines up with a cyclical outlook. And when those two things come together, you've got something. And look, earlier we had a cyclical upturn. We have a structural change with a huge investment in AI. I'm not surprised that you get above trend growth.